I think there is kind of a sustainable move here to the upside in commodities over time. And if you haven't built a portfolio yet in commodities, I mean, the market is just giving you another opportunity right here.
Please join us for our next live stream Sunday, July 24th at 9 p.m. Eastern. We'll go over current events, past guests, and of course, gold and silver news. Once again, our next live stream will be Sunday, July 24th, 9 p.m. Eastern. See you then. Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira. Tavi Costa from Crescat Capital joins us again today. Tavi is a portfolio manager at Crescat Capital and has built Crescat's macro model that identifies the current stage of the U.S. economic cycle through a combination of 16 factors. His research has been featured in the financial publications such as Bloomberg, The Wall Street Journal, CNN, Financial Post, to name a few. And we're delighted to have Tavi on board once again today. It's time to saddle up and silver up for Tavi Costa. Tavi, welcome back to SBTV. How are you doing?
Patrick, thanks for having me. Looking forward to this.
Glad to have you back on board. You know, Tavi, I was reading through Crescat Capital's June monthly research letter titled The Rise and Fall of the Consumer. In it, it was written, the Fed is facing one of the worst predicaments of its existence as it continues to raise interest rates into an economic downturn. And the problem is that sooner rather than later, it'll be forced to relent and inject liquidity into an already inflationary environment. Tavi, are you looking at the Fed going back to QE?
Well, ultimately, the Fed is trapped, and ultimately, we're going to see some sort of liquidity injection in an already inflationary environment. I think what most of my concerns are, which I think the economy will be in a very bad place in about 6 months from now. And prices in equity markets and risky assets might actually going to be leading to those issues very quickly. I'm very concerned about the consumer picture overall. I mean, we've had one of the biggest government finance stimulus or economic activity that we've seen in history, driven by literally the government giving money to consumers to spend. And so we saw saving rates go up to about 30 to 35% relative to disposable income. And now it's back down to less than 4%, which is near historical lows. On top of it, now you got wages and salaries, which were growing, but not outpacing inflation. So they're actually in real terms at very low levels, even lower than what we saw back in the global financial crisis. And so the consumer is getting squeezed. Mortgage rates are increasing, which also tends to have a very large impact in consumer spending. And so it's quite concerning how that's going to look like. Their sentiment is collapsing, as a lot of people have seen. Consumer sentiment is at the lowest levels in history. And that usually tends to lead what we see in corporate earnings. And so consumption falls, you tend to see corporate earnings also compress. And so that's kind of the picture that we may see in about 6 months from now. And it's particularly important right now with earnings release to be looking at not only actual earnings, but guidance, because guidance is going to be, probably going to be impacting share prices as we go here.
We'll touch on a few of those things in a bit. Inflation numbers running pretty hot. CPI recently came in at 9.1%. And the chatter is the Fed may raise rates 100 basis points coming the next FOMC meeting. When might we see the Fed actually start to have to pack it up and again turn around? How much longer can they go raising rates?
Well, I don't think we're going to see a lot of, I think this is going to look like 73, 74 when we've had that decline in equity markets was about, 25 to 30% decline. And then the Federal Reserve was basically forced to pause their interest rate increases and actually had to reduce interest rates at some point. But basically we went on a pause for a couple months there, or more than a couple months, until we resume interest rate increases because of oil prices increasing. And the similarity here is because I think that the level of monetary tightening on top of what we may see with consumption falling off a cliff may actually cause a steep recession here. Watch what's happening with the yield curve. The yield curve is now, you look at the Federal Reserve hiking cycles of the last 30 years. It's quite interesting that every time we've seen yield curve inversions to the levels that we've seen right now, usually that causes the Fed to pause. And so what is scary, though, is that inflation is completely understated in terms of what government is reporting. However, it has been, in terms of a pace, decelerating all the way back to March. You look at commodity prices have come down. Majority of things have come down significantly from, I shouldn't say significantly, but slightly from March. Not only commodities, but actual price of things. And so the problem with this is that the Fed is actually accelerating as the pace is declining. And so the part of the pace to being declining as well has to do with consumption and economic activity slowing down drastically. And so to me, that's the concerning part, is that tightening cycle as the economy is starting to show some issues. And so I'm quite concerned we're going to get into a recession here very quickly. So I think this is what causes the Fed to have to reverse its policy.
So, what do you think the Fed needs to do? I mean, we're saying it has to reverse its policy, but is there anything that the Fed can do, short of continuing to raise rates, and short of people, let's say, losing their jobs?
The job of the Fed right here is only really to hurt demand. They can't do anything about supply. We know supply of commodities are extremely constrained. And they certainly will continue to be that way because of the capex trends that take a long time to reverse. As far as what the Fed can do, it's important to go back to that 73, 74 times, because what it took the Fed not only to raise interest rates over 500 basis points during that time, starting from 500 basis points and raising another 500 or so. But what took at that time was really a completely crashing equity markets. Equity markets declined about 50% during that time. And so, maybe that's kind of the scenario we may see in order to get things reordered in terms of inflation. But I think the inflation gene is out of the bottle already. And so it's going to be difficult. That's why I think in 6 months from now, we're going to be in a very tough position, because it's going to be a classic stagflationary environment when unemployment rate starts to increase and labor market starts to deteriorate after the fact of corporate earnings decline and consumption falls off a cliff. It's going to be a tough environment for the Fed. What do they do? I mean, can they really continue to raise rates to fight inflation as you see the economy really decelerating and maybe in a very significant downturn, which I think we will be? So the Fed completely made a major mistake in 2021. This is in hindsight, but all leading indicators are showing that inflation was not transitory, especially in the middle part of the year. I think the beginning part of the year was maybe arguably a little more difficult to make a call, but at the later parts of the year, they're still printing money. Still printing money when interest rates at zero, while we're seeing all those issues developing in the economy. So that was the problem. And now the only way to fix this is late in the game, is tight monetary conditions, late in the business cycle, with valuations now only now retesting what were back in the tech bubble. With that problem at the levels that we have today, it's going to be hard to not see risky assets completely collapse. So it will take a recession. They're probably going to have to take interest rates higher. And so in the short term, and as they call the front loading interest rate hikes. And so they're probably going to have to do that. That's the only solution here. And in order to completely hurt and impact negatively the equity markets, I think that's coming here.
Tavi, the last time the official U.S. inflation rate rose to over 8% from the lower bound was back in the 70s, as we kind of touched on here. And a stagflationary period of high inflation and low economic growth, much like today, ensued. It ended with the gold and silver price reaching record highs, 850 for gold and 49 for silver, respectively, back in 1980. And while history may not repeat, it does sometimes rhyme. Do you think we'll see gold and silver move up once again and have their historic highs and hopefully maintain them for a while?
Yeah, I mean, look, I've been wrong on gold and silver here, even though gold has made new highs not too long ago, back in March, or especially in other currency terms. But I do think we are about to see something very strong appreciation in most precious metals, and that's just because the Fed is trapped ultimately, and will have to reverse most of these policies that we're seeing right now because the economy really cannot handle this level of monetary tightening at all. And so it's hard to believe we're not going to go back to a world where currencies, fiat currencies, are actually depreciating relative to gold, and we're still seeing that in terms of currencies outside of the dollar. I mean, look at the gold price, even relative to the euro or Japanese yen and so forth. I mean, those are important signals here that we're probably going to see the same here against the dollar. And so, to me, stagflation is an environment where I think we all like to look back in history and think about what is the best analog for where we're seeing today. But today is a completely unique environment. Why? Because we have a trifecta of macro imbalances. We have the debt problem of the 1940s, the inflation problem of the 70s, and the valuation problem of the late 90s during the tech bubble. And so it's hard to believe that the Fed has any flexibility to prevent inflation from persistently infiltrating the economy. And so it is a very, very difficult job right now to be a policymaker. And to me, that's going to translate into higher gold and silver prices. This is precisely why we buy a lot of exploration assets that we think are going to do very well in the next 5 to 10 years. Literally, I mean, this is a long-term play that I think is as attractive as it gets, especially at depressed levels that we are today.
I was just going to ask you about that. How do you expect the miners to fare in this upcoming recessionary period, or even into a stagflationary period?
Miners may get caught up here and there, and it's important to remember a very key moment in history when we had stagflation was 73, 74. Equity markets declined about 50%, as I noted recently, but also you saw gold miners actually go up fivefold during that environment. So while a lot of people like to go back to '08 and 2020 when we had equity markets getting crushed and gold miners being dragged along with it, there are times in history that we had stagflation, not in '08 and not in 2020, when actually gold miners did very well during that environment. And that's mostly because you see inflation rising, and the Fed is in a recessionary environment and can't really do much, and it has to allow inflation to continue to rise. And so even though it may decelerate as the economy really slows down or actually contracts significantly, which happened at that time. And so that is why you see that flight to safety, and some of the miners actually appreciate during those periods. To me, that's more of an analog than '08. That's why I don't think we're in an '08 environment at all. It surprises me that we're seeing, not surprises me, but it is amazes me how much of a decline we're seeing in copper and oil right now, given how constrained supply wise those commodities are. And not only right now, I mean, historically, if you look back in other times in history, this is one of the most constrained periods for commodities we've seen in history. And so it is mostly the concerns on the consumption and the demand side that are really driving this, and which goes to show how probably things are going to get very bad here demand wise, from the consumption side very soon.
If you're enjoying this interview with Tavi Costa and I, please consider subscribing to our YouTube channel and giving us a thumbs up to let the algos know you want more content like this. And if you want to learn more about systemic wealth protection, please do visit us at www.silverbullion.com.sg. I guess that kind of answers the next question I was going to ask, where precious metals, other commodities, they have never been cheaper relative to the Dow Jones Industrial Average in 120 years, but yet we're seeing it now. Despite the rising prices of certain commodities such as oil, industrial metals, and grains on the back of higher inflation in the past year. So I was really going to ask you, why are these real things, the real things, copper, gold, silver, nickel, things like those, meeting such strong headwinds?
Well, I think you're seeing, first we saw a huge appreciation from, I think the the massive stimulus from governments that we saw in 2020 that caused this level of economic growth, which was totally a sugar high, um, unsustainable type of growth that we saw in 2021, really expose the supply constraints from commodities, because we had demand, really surging at that time. I mean, we saw levels of stimulus relative to GDP that we've never seen before from a monetary and fiscal side that completely drove consumption through those policies. And so, is it sustainable? Probably not. We're not going to see the same level of policies that we saw in 2020 and 2021 that we saw back then. So right now, the supply side seems not to be as constrained, but we know that throughout history, the whole commodity cycle is predicated on really one important thing, which is called the capex, long-term capex trend. And what you see today is not what we saw back in '08, which I think is ludicrous to make, assumptions that we're back to levels like we saw back then, because back then we saw a huge amount of infrastructure developments and capital spending. And in fact, the capex trends of commodity producers at those times were at peak levels. Today, we're basically, especially adjusted for GDP, because the dollar amount that you spend back then, adjusted for GDP, since economic activity is much larger than it was in '08, not only in nominal terms, but adjusted for GDP, is at a 19-year low. And so how do you justify where we are? And we know that this takes a long time to be reversed. And so on top of it, you got the political effort against not allowing those companies actually to perform the way they would in a normal environment. So it's hard to believe that this is not the beginning of a bull market for commodities. We're seeing a pullback. We all know how commodities react. They're very volatile. It's a small market. And so to me, you want to be buying the dip in commodities and selling the rallies in very expensive financial assets. I mean, if you think a bubble in technology companies and a bubble in equity markets as a whole only lasts about 6 months or so, and only goes back to levels that we only seen valuations back in the tech bubble, I think you're out of your mind. I think we're going to see a lot lower in terms of reckoning of valuations of equity markets as we see this economic growth really starting to contract here very soon.
Do you think maybe governments will have to kind of ease up on restrictions, especially for the miners?
I do actually. I think we're at the beginning of some of those conversations. The problem is, you look at policymakers, they can barely put two sentences together about mining, and so it's difficult to even come up with policies when they can't even understand how natural resources are developed and explored and produced. And so I think that that's a hurdle that we're going to have to go through for many, many years until people really realize that mining is absolutely necessary to have all the materials that we have to function in the economy. And so to me is going to have to be through some sort of a government intervention at some point to help those companies to succeed. But I think we're far away from that. I think we're just at the beginning of those conversations, but that will take a long time until government gets really involved. I think my idea here is that I think we're going to see at some point subsidies and things like that really starting to help projects that were not economically viable, but maybe become viable just because of the need for those minerals or for geopolitical reasons and so forth. That strategically you need to have those deposits being developed here in the U.S. And so, but there's a lack of understanding, Patrick, of how long it takes to fix a supply issue for mining. I mean, mining is a very, it takes at least, if the government is out of the way, it will take 5 years. That's with the government not being in the way. I mean, without, today, forget about that. It would take about, 7 to 10 years to get something going in terms of from exploring to producing. And so, it's going to be very difficult. Regardless, it takes a long time for those patterns to really reverse, and that's why I think there is kind of a sustainable move here to the upside in commodities over time. And I think this is, if you haven't built a portfolio yet in commodities, I mean, the market's just giving you another opportunity right here.
Yeah, I mean, again, it's interesting because you already see where certain countries, politicians, they already have created their space where they're going to go ahead with the green movement. But then again, you have other factions where they're saying, "Hey, wait a minute. The reality is we need energy still. We need these other certain commodities still. We still need coal. We still need these other things." So I think it's going to be interesting how it's going to play out. Do you think that we may have to kind of rethink what we want to do as a society?
Well, it might start with, which is, very much of a hypocrite kind of comment, but I think it will start with importing from third world countries most of those natural resources, that and having them actually going through the environmental issues of mining those resources in general. And But we're going to have to go through that conversation that you just said with conservatives and liberals. Obviously, liberals are the ones pushing back on that mostly. But it's going to be absolutely critical. I mean, if you want to have a house, you want to have a car, you want to have clothing, everything needs natural resources. And so we're going to need, that conversation seems to be a little bit too far out still, but I think we're going to have to go there. To me, it's surprising because, in terms of investing, you have retail investors always chasing markets, right? I mean, you see something going up a lot, retail investors come right after those moves rather than doing the quite opposite. But it's important to investors as a lesson is that you never want to chase a market. You want to be developing your strategies when things are not, needing to be chased. And so markets will always give you an opportunity, another opportunity to come in. And here's the market giving you another opportunity, right? I mean, we're seeing a decline, and a lot of people will come up with new ideas. This is '08 again. We're going to see a collapse in the banking system and all that. And sure, there's a lot of imbalances here in the U.S. I just talked about the trifecta of macro imbalances, but this is, as important, as critical as it gets to be able to hedge your inflation for inflation problems ahead. I think we're going to see waves of inflation going forward. I think we're going to see tangible assets outperforming financial assets in a large way in the future, which goes back to your commodities to equity ratio chart. I'm a firm believer that that's one of the most intelligent ways to be allocating capital today. And so, we have a very long portfolio, a large portfolio of long commodities, and then we hedge that by being short equities. We've been doing this for a while now, and that portfolio is actually well protected this year. So I think you want to be doing this over time. And when you have a pullback like we had in commodities, if you're not taking advantage of it and you're changing your view because someone is telling you this is '08 again, I think you need to do more due diligence. I think you need to do more research, because I think that's just an incorrect assumption here.
Tavi, has your portfolio weighting adjusted a bit where you're putting more into, let's say, commodities?
Yeah, I mean, with I think there's I've been saying this before. I guess to me, this is kind of like the '90s, early '90s and mid '90s. We've had technology really kind of coming into play, and very few people knew how to navigate the space. There was the beginning of folks becoming experts in the technology front, and so very very few people knew how to really investigate those opportunities at that time and figure out which ones were investments that were worth deploying capital into. And so it created a lot of inefficiencies early in those stages that turn out to be actually at the end of it a bubble, where we've had most of those assets going up later on. But the beginning of it was kind of the Wild West, where nobody knew how to discern what is a good and bad investment, because there was no real metrics to be looked at. To me, even though the mining industry has been in place, for longer than most industries, what is interesting right now is that the declining trends of geoscience enrollments in universities and just interest in general in geology, it has caused a lack of participants in markets that actually know how to discern those investments in the mining space as well. So you have in the exploration realm, you have a lot of companies putting out discovery holes and very interesting data as far as the probability of actually finding a world-class discovery, and they're not being priced accordingly because the market doesn't know how to interpret that data. And so what a time to be able to really focus on things that are worth a lot of money today that are not being priced accordingly. They have a very high probability to have a world-class discovery that most likely will get purchased by the big miners that have capital to be purchasing those at some point as they have their reserves being depleted, and we see another M&A cycle inside of the commodities place. It's a time I've never seen before. So it's not only a capital trend, it's a labor trend that is causing a lot of inefficiencies, and inefficiencies are opportunities. And so I'm very excited about being able to build a portfolio very niche-y in that environment right now. So basically, we've been invested over $200 million of capital into mining companies, and most of them are exploration companies, over 90 businesses that we now have invested. And a lot of them we own about 20% of those companies, where those are companies that are actually exploring what we think are going to be world-class discoveries. And so, sometimes in a portfolio like this, you want to just be lucky to have one discovery. Right now, I think we have a lot more than that. We may have, 20 or so companies that actually have very, very interesting discoveries. And maybe one or two of those may actually be one of the largest discoveries we've seen in the last decade. And so and again, the market is not appreciating those assets at all as of today. And we know that when you get to a bull market in gold, empirically, who really returns better than the majors is actually the smaller cap names, especially at the beginning of, or I shouldn't say the very beginning, but throughout the first, call it all the way up to the 5 innings of mining. And so it's quite interesting right now to be allocating capital towards that. I would say 50% or so of our assets are in long assets, in commodities, are in precious metals, maybe a little more today, maybe 60% because of the pullback we've been adding. So about 60% has been in most of those precious metals and base metals exploration assets. And then we have, call it 20% or so in oil companies and energy companies in general that we think are going to do very well, nat gas companies and so forth. And then another, call it 15% are in agricultural commodities that we think could also do very well. And then, and so that's really kind of the bulk of our long assets in the commodity space.
Tavi Costa from Crescat Capital, before we wrap up, can you let our viewers know how they can follow you or even contact you?
Yeah, they can follow me on Twitter at Tavi Costa. They can also see some of our letters and research that we put out, and also information about our funds in the Crescat.net website. So go to Crescat.net. And also we put out videos on YouTube where we talk about macro every Friday at 2 p.m. Eastern, where we talk about not only the macro environment, but also we talk about some of the companies that we have invested in this exploration area of the industry, along with other development companies too. So if you're interested in geology, that's a good way to learn a little bit more.
All right. Sounds interesting. Tavi, we want to thank you for your time, and I look forward to seeing more of your charts and outlooks, and I hope we can do this again soon.
Absolutely. Thanks for having me.
That was Tavi Costa sharing his views on the economy and precious metals. For more info on Tavi, please visit Crescat.net. If you like this video, please give it a thumbs up, subscribe, and share to let the algos know you want more content like this. Audio-only versions of this interview can be found on iTunes and Spotify.